Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
So Josh, everyone is still looking at Tokyo through this 1990s lost decade perma-deflation lens. They think the Bank of Japan is playing the same old game. But if you actually look at the macro under Prime Minister Sanae Takaichi, what we are seeing is a structural regime shift. This isn't your grandfather's Abenomics. This is what she calls Sanae-nomics. And it's a high-pressure fiscal gamble that is basically blowing up 30 years of monetary history.
Sananomics. I mean, it sounds like a sequel that has a way bigger budget, but a much messier script, Dad. You're talking about active fiscal expansion, but look at the actual growth. The real GDP growth for 2026 is struggling to crawl past, 0.7 to 1%? Yet we've got core CPI consistently printing above that 2% Bank of Japan target. That's not a roaring engine. That looks like a car with a stuck thermostat and a leak in the radiator.
Well, the thermostat is stuck because of import energy costs, yes, but the structural shift is real. Takaichi is running a high-pressure economy. She is intentionally using fiscal deficits to force wages up and drag the country out of its deflationary mindset. But here's the thing. The Bank of Japan can't play the enabler anymore. Governor Ueda is practically forced to raise rates. We're looking at a historic trajectory here. They've already moved away from negative rates, and the market is now pricing in a policy rate of 1.25, maybe even 1.75% by fiscal year 2027. Do you realize how massive that is for a country with a debt to GDP ratio north of 260%?
1.75%. I mean, on one foot, if you told a Japanese regional banker 5 years ago that they'd see a 1.75% policy rate, they would have asked for whatever you were drinking. That debt to GDP math is brutal. If the cost of servicing that massive mountain of sovereign debt goes up by even 100 basis points, the fiscal deficit is going to eat itself. Takaichi is basically redlining the engine, hoping the structural growth outruns the interest expense. But I don't know, Dad. Historically, when you run a high-pressure fiscal policy into a supply-constrained economy, you don't get a soft landing. You get a real structural mess.
Exactly, and that's the risk. The Fed tried this high-pressure economy theory back in 2021, and we saw how that turned out. Now, Japan is doing it with far worse demographics and a sovereign debt profile that looks like a towering Jenga block. Ueda is trying to be orderly, but the market is going to force his hand. If core inflation stays above 2%, because of those structural import costs and a strengthening yen now, which we'll get to, the BOJ has no choice but to tighten. They are dismantling the yield curve control. They're letting JGB yields rise, and that is sending shockwaves through the entire global financial plumbing.
Yeah, the plumbing is definitely rattling, and the pressure gauge on that boiler is the labor market, which brings us to the actual fuel inside this domestic engine.
And that fuel is wages. Look at the Rengo Shunto results. The Union Federation secured a 5.6% wage hike. 5.6% in Japan. It's a multi-decade high. For 30 years, corporate Japan's entire business model was based on flat wages, lifetime employment, and cutting costs. Now they are being forced to completely rewrite the playbook.
Right, but let's look at who is actually paying that bill. 5.6% shunto hike is great if you're a salaryman at Toyota or Sony, but 70% of the Japanese workforce is employed by SMEs, small and medium enterprises. These are the mid-market firms, the component suppliers in Shizuoka, or the machine shops in Ota. They don't have the pricing power to just pass those labor costs down the line. We're seeing SME bankruptcies hit a 10-year high because they are getting squeezed between soaring wages and big buyers who refuse to pay more. Ueda talks about this beautiful self-sustaining wage price spiral, but on the ground, it's a mid-market crack.
It's a severe bifurcation, Josh. You've hit on the key structural flaw. Ueda's model assumes that higher wages lead to stronger domestic consumption, which then allows firms to raise prices, creating a virtuous cycle. But that model was built for a closed, balanced economy. Japan is not that. If the small firms, the ones that employ the vast majority of people, can't pass on costs, they don't hire, they don't expand, they go bankrupt. We're seeing zombie companies that were kept alive by zero interest rates and flat wages finally hit the wall. The failure rate is accelerating. So you have this bizarre situation where the top tier multinationals are cash rich and raising wages, while the domestic engine is sputtering and cracking under the weight of those very same wage mandates.
It's like trying to run a marathon when your left leg is twice as long as your right leg. You're going to trip. As an advisor, when I look at this, I tell clients to stay far away from domestic-focused Japanese small caps. They are in a vice. The big boys can automate, they can offshore, they can handle a 5.6% bump because they've got global margins. But the local distributor, the regional food processor, they are absolute toast. They're paying tuition on this new economic model, and the tuition is bankruptcy.
And the Bank of Japan is basically saying, so be it. They want consolidation. They want the weak, low productivity firms to die off so that capital and labor can reallocate to more productive sectors. It's a brutal Schumpeterian creative destruction. But they are doing it at a time when the global economy is already highly fragile. And the real danger isn't just domestic. When these Japanese corporations and more importantly, Japanese institutional investors start shifting their capital, the rest of the world is going to feel it very, very quickly. Which leads us to the big global story, the massive sovereign shift. For decades, Japan has been the world's largest creditor nation. Japanese life insurers, pension funds, Mrs. Watanabe, they've been starving for yield at home, so they exported trillions of dollars of capital. Most of it went straight into US Treasuries. But the math has fundamentally changed, Josh. The math is broken for them now.
Let's actually do that math because this is where the rubber meets the road. If you're a Tokyo-based lifer, say Nippon Life or Meiji Yasuda, and you buy a 10-year US Treasury yielding, 4.2%, you can't just run that currency risk naked. You have to hedge the dollar back into yen. And because the short-term interest rate differential between the US and Japan has been so wide, the cost of that FX hedge has been eating up the entire yield. In fact, it actually goes negative. You end up with a net hedged yield of less than 1%, maybe even zero on a US Treasury. Meanwhile, domestic 10-year JGB yields are climbing toward 1.5%. 1.5% with zero currency risk and zero hedging costs looks like a absolute gold mine compared to a hedged US Treasury.
Exactly. A domestic 1.5% JGB beats a hedged 4.2% Treasury all day long. And this is why we are seeing a massive structural repatriation of capital. This isn't a temporary flow. This is a tectonic shift. Japanese institutional lifers are letting their US Treasury holdings mature, and they are redirecting that cash right back into domestic yen-denominated bonds. Japan has over $1.15 trillion in US Treasuries. If they stop buying, or worse, if they start actively selling to fund domestic purchases, who is going to step in to finance the US government's multi-trillion-dollar annual deficits? The primary liquidity pillar of the global financial system is literally walking away.
And it's not just the lifers. Look at the Government Pension Investment Fund, the GPIF. That's the largest pension fund in the world, managing nearly $2 trillion. They just executed a 250 basis point reallocation toward domestic debt. 2.5% of that fund doesn't sound like much until you realize that's $50 billion of global liquidity being pulled out of international equities and bonds and stuffed back into JGBs. They are literally starving the US Treasury market to feed the domestic Japanese debt machine. It's like a giant vacuum cleaner running in reverse.
And this is why the bond vigilantes are looking at Washington with such hunger. The US has been able to run these massive pro-cyclical deficits because Japan was always there as the buyer of last resort. If Japan is repatriating its capital to fund its own domestic high-pressure economy, then the US Treasury has to offer higher yields to attract other, more price-sensitive buyers. This is a direct transmission mechanism from Tokyo's monetary policy straight into US mortgage rates, corporate borrowing costs, and the federal debt service bill. It's a global repricing of risk, and it is happening right now.
It's a massive margin call on the US deficit. And it's hitting the corporate sector too, especially with the currency moving the way it is.
Well, the currency is the other side of this double-edged sword. We've seen the yen strengthen by something like 12%, down to around 130 yen to the dollar. Now, if you are a global Japanese giant like Toyota or Sony, you budgeted your fiscal year 2026 outlook on a rate of, 145? A sudden move to 130 is a massive, immediate margin shock. It literally wipes out billions in repatriated export earnings.
Oh, the 130 shock it's brutal for the big exporters. I mean, Toyota's sensitivity to the yen is legendary. Every single yen of strengthening against the dollar cuts billions of yen off their operating profit. So at 130, their guidance is basically in the shredder. But what's interesting is how the government is responding. They aren't just crying about the strong yen. The Ministry of Economy, Trade and Industry, METI, they are launching this 3 trillion yen automation and domestic semiconductor capacity fund. They're basically telling these companies, look, you can't rely on a cheap yen and cheap labor anymore. You have to automate, and you have to bring your supply chains back home.
And that is the real structural pivot. METI is trying to use this crisis to force a technological upgrade of the entire domestic industrial base. If you can't find workers because of the demographic collapse, and you can't rely on a cheap currency, you have to use robots, you have to use advanced AI, you have to build domestic fab capacity. But notice the fiscal offset here, Josh. Takaichi isn't just funding automation. She is running a record 8.9 trillion yen defense budget. That is, it's a massive domestic economic multiplier. They are building up a domestic defense industrial complex that is pouring money directly into heavy machinery, aerospace, and advanced electronics contractors right inside Japan.
Yeah, the defense pivot it's a huge domestic stimulator. If you're Mitsubishi Heavy Industries or Kawasaki Heavy, your order book is filled for the next decade. That's a massive Keynesian injection directly into the heavy industrial sector. So while the export-oriented auto sector is taking a beating from the 130 yen shock, the domestic-facing heavy industrial and defense sectors they're getting a massive government lifeline. It's a complete restructuring of the Japanese corporate landscape. We're moving from a export-led economy to a state-directed, defense and technology-led, high-pressure economy.
But let's not lose sight of the leverage, Josh. All of this, the 3 trillion yen Medi Fund, the 8.9 trillion yen defense budget, this is all debt financed. She's doubling down on the national balance sheet. And while they are doing this, they are setting off a giant financial bomb that is sitting in the global carry trade. This is the real systemic risk. The Bank for International Settlements, the BIS, they issued a warning that the global yen-denominated carry trade is around $2 trillion. For years, investors have borrowed yen at zero interest rates, sold that yen for foreign currencies, and bought higher yielding assets elsewhere. Mexican pesos, US tech stocks, European sovereign debt. But now, as the BOJ raises rates and the yen strengthens, that carry trade is unwinding. And when a $2 trillion trade unwinds, people get hurt.
Oh, they get carried out on stretchers, Dad. We've already seen the first tremors. Look at the European sovereign market. Italian BTP spreads over German bunds widened by 45 basis points almost overnight when the yen started its run. Why? Because leveraged funds were borrowing cheap yen to buy high-yielding Italian debt. And look at the Mexican peso. It took an 8% dive in a matter of days. That is the classic carry trade unwind signature. When the funding currency, the yen, starts costing more and appreciating, you have to liquidate your long positions in a hurry to pay back the loan. It's a violent margin call on global leverage.
It's a liquidity contraction of global proportions. The BIS is right to be worried. The problem is that the global financial system has become addicted to this cheap yen liquidity. It acted as the lubricant for all kinds of speculative bubbles. If that lubricant is dried up because the BOJ is normalized at 1.5%, then asset valuations everywhere have to adjust downward. The risk premium has to go up. This is why we are seeing this high volatility new normal in global portfolios.
So how do we position for this? If you're managing a global portfolio, the old rules are dead. You can't just buy and hold the standard US 60-40 mix and expect it to work when the global liquidity tap is being turned off. You have to underwrite for this volatility. I'm telling clients, you want short duration, high quality, cash generating assets. You want to be long the yen as a structural hedge against global liquidation events. And you want to avoid highly leveraged, speculative foreign assets that were funded by that cheap yen carry. It's about survival first, and then looking for those dollar for 50 cents opportunities when the panic selling hits.
Well, I agree on the cash flow focus, but let's be clear. This Japanese sovereign debt experiment is entering its final, most dangerous phase. If Takaichi's high-pressure fiscal policy fails to generate real structural growth and instead just drives up interest rates and inflation, Japan's debt servicing costs they'll spiral out of control. We are watching a slow-motion wrecking ball swing toward the global financial system, and policymakers are completely unprepared for the impact.
Well, let's hope those Medi robots can work fast enough to save us. All right, that's a lot of macro homework for one day. Good chatting, Dad. Let's see how the next batch of JGB auctions goes.
Well, what's the tape, Josh? Talk soon.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation with a member of our team, Robert, Joshua, Andrea, Mike, or Eugene, and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.